The bear case for G Mining Ventures. The market narrative surrounding G Mining Ventures has, since its inception in 2020, been characterized by a perceived Midas touch in mine development. The corporation's flagship Tocantinzinho (TZ) project in Brazil was heralded as a masterclass in execution, transitioning from construction to commercial production on schedule and on budget, a rarity in the modern mining cycle. This operational success, coupled with the acquisition of the Oca West project in Guyana and the subsequent multi-billion-dollar consolidation of G2 Goldfields, has propelled the company's valuation to levels that suggest a virtual absence of risk. However, an analysis of the underlying data clusters, operational metrics from the first full year of commercial production, and the escalating capital intensity of the Guyanese growth pipeline suggests that the corporation is now significantly overextended. The bear case for G Mining Ventures is not predicated on the failure of its assets, but rather on the widening divergence between a priced-for-perfection equity valuation and the mounting geological, fiscal, and geopolitical headwinds that are systematically eroding the company's margin of safety.
Valuation disconnect and the perils of peak pricing. The most immediate concern for investors is the sheer scale of the premium currently assigned to G Mining Ventures. As of April 2026, the company's market capitalization has reached approximately $8.94 billion USD. To put this in perspective, the market value of the entity was a mere $81 million in 2020, representing a compounded annual growth rate that is almost unprecedented for a mid-tier miner. This valuation surge has been driven by a combination of high spot gold prices and the successful ramp-up of T/Z, but it has resulted in trading multiples that are significantly detached from industry peers. The corporation currently trades at a price-to-earnings ratio of approximately 33.9x, which stands in sharp contrast to the Canadian metals and mining industry average of 19.4x. This PE premium is particularly precarious given the company's transition from a developer to a producer. Typically, as miners move into steady-state production, their multiples compress to reflect the operational risks and the finite life of their assets. G Mining, however, has seen its multiple expand, as investors treat the company as a growth platform rather than a traditional mining entity. The bear case argues that this growth premium is vulnerable to a sharp correction if the next phase of development, the $1 billion Oca West build, encounters even minor setbacks. The discrepancy in the price-to-sales ratio is perhaps the most alarming data point. At 18.4 times sales, G Mining is priced more like a high-growth technology stock than a cyclical materials producer. This is especially concerning because the company's revenue is fundamentally capped by the capacity of its process plants and the grade of its ore. Unlike a software company that can scale with minimal marginal costs, G Mining must contend with the inflationary treadmill of mining, rising labor costs, deepening pits, and the constant need to replace depleted reserves. The current valuation suggests that the market is pricing in not just the current reserves, but a level of exploration success and operational longevity that has yet to be proven by the drill bit.
Operational fragility. Unpacking the 2025 performance miss. The 2025 operational results from Tocantinzinho provide evidence that the asset is not immune to the challenges of steady-state mining. For the full year 2025, TZ produced 171,871 ounces of gold, which was 2% below the lower end of the company's own guidance range. While a 2% miss might seem marginal, the underlying reasons for the shortfall are symptomatic of structural risks. Management attributed the miss to a slower-than-expected operational ramp-up and lower head grades processed. Grade reconciliation is the silent killer of mining valuations. If a mine consistently processes ore that is lower in grade than the feasibility study predicted, the entire financial model, including the $1 billion net present value, must be called into question. The 2025 variance indicates that the geological model for TZ may have overestimated the grade of the initial mining benches, or that the ore body possesses more complexity and dilution than previously understood.
Furthermore, the fourth quarter of 2025 highlighted the mechanical vulnerabilities of the TZ processing plant. In November 2025, the operation suffered unplanned downtime due to a failure of the ball mill motor bearings. This incident is a critical point for the bear case because it exposes the lack of redundancy in the company's current cash flow profile. As a single asset producer, any significant failure in a primary circuit like the ball mill has an immediate and non-recoverable impact on the quarterly bottom line. The 2026 guidance already reflects these headwinds, with production at TZ expected to be essentially flat or even lower, 160K to 190K ounces, while costs are projected to rise significantly. The escalating cost profile and fiscal headwinds in Brazil. The narrative that G Mining is a first quartile cost producer is increasingly challenged by the cost inflation seen in 2025 and guided for 2026. Total cash costs at TZ in 2025 averaged $748 per ounce, exceeding the upper end of the guidance range by 9%. This escalation was driven by two primary factors: rising operational costs and a shifting tax regime in Brazil.
In 2025, the state of Pará introduced a new production tax that added approximately $27 per ounce to the cash cost of every ounce produced at TZ. Simultaneously, higher gold prices led to higher royalty expenses, adding another $27 per ounce. These are not transitory costs, they are structural changes to the project's economics. When G Mining acquired TZ from Eldorado Gold in 2021, these state-level levies were not part of the feasibility calculations. The fact that the government of Pará was able to implement a new tax so soon after the mine achieved commercial production highlights the jurisdictional risk of operating in Brazil, where the mining sector is often seen as an easy target for fiscal consolidation. The 2026 guidance is particularly bearish, with AISC projected to rise to as high as $1,444 per ounce, a 25% increase over 2025 actuals. This increase is attributed to a catch-up in sustaining capital and higher waste stripping requirements as the pit deepens. For an investor paying a 34x multiple, a 25% increase in the cost of production is a significant erosion of the investment thesis. Additionally, the Brazilian Congress approved Bill No. 128/2025 in December 2025, which reduces federal tax incentives and increases taxation on certain financial instruments used by miners, such as interest on net equity, INE. The withholding tax on INE will rise to 17.5% in 2026, which will likely impact G Mining's ability to repatriate cash from its Brazilian subsidiary efficiently. These cumulative fiscal pressures suggest that the free cash flow generated by TZ may be significantly lower than the headline numbers suggest once all taxes and sustaining capital are accounted for. The Guyana frontier, capital intensity, and the synergy trap. With the $3 billion acquisition of G2 Goldfields and the ongoing $1 billion build-out of Oko West, G Mining Ventures has shifted its primary risk exposure to Guyana. The bear case maintains that management is attempting to replicate the TZ success in a jurisdiction that is fundamentally more challenging and at a scale that will test the limits of its balance sheet. The capital requirements for Oko West are staggering. The 2025 feasibility study for Oko West estimated an initial capital cost of $973 million. For 2026 alone, G Mining has guided for growth capital expenditures of $514 million to $568 million. While management claims the project is fully funded through cash on hand, an undrawn $350 million credit facility, and TZ cash flow, this assumes that TZ performs flawlessly and gold prices remain near record highs. The synergy case for the G2 Goldfields acquisition is another area of concern. Management has guided for $1 billion in identifiable, quantifiable synergies by combining G2's Oko-Ghanie with G Mining's Oko West. However, these synergies rely on shared infrastructure and an addendum to the existing permitting framework, rather than a new environmental submission. This is a high-risk regulatory assumption. Guyanese environmental authorities may not allow the integration of a second major deposit under an existing permit, potentially forcing the company into a full environmental and social impact assessment (ESIA) for Oko-Ghanie, which could delay the expanded production target of 2029 by several years. The premium paid for G2 Goldfields, 72% over the 30-day VWAP, reflects an expensive acquisition that was only possible because G Mining was able to leverage its own elevated valuation. If the market begins to sour on G Mining stock, the ability to fund future acquisitions or cover capex overruns through equity issuance will evaporate. The acquisition effectively increased G Mining's share count by millions of shares, diluting the current production at TZ to pay for a promise of production in Guyana in 2029. Geopolitical and jurisdictional risk, the Venezuela dispute. Perhaps the most significant black swan risk for G Mining is the ongoing territorial dispute between Guyana and Venezuela.
The Maduro government in Venezuela has claimed sovereignty over the Essequibo region, which includes the Oko West and Oko Ghani projects. While management and some analysts downplay this risk as a nationalist distraction, the reality is that 11.7% of G2 Goldfields was recently purchased by Anglo Gold Ashanti precisely because the junior was being punished by the market for this geopolitical exposure.
By consolidating the district, G Mining has effectively doubled down on a disputed territory. While a military conflict is considered a low-probability event, the geopolitical overhang will likely prevent the stock from achieving the kind of valuation re-rating that management expects from a Tier 1 asset. Major institutional investors and sovereign wealth funds are often precluded from holding significant positions in companies with assets in disputed borders, which may cap G Mining's institutional ownership and liquidity in the long term. Furthermore, the Guyanese economy is currently undergoing a massive transformation driven by offshore oil discoveries by ExxonMobil. This has led to extreme competition for skilled labor, construction equipment, and logistical support. G Mining is building a $1 billion mine in direct competition with a $50 billion oil industry. The capital cost inflation and schedule delays that management warns about are not just boilerplate legal disclosures. They are the inevitable consequence of building a mine in a hyperinflated developing economy. Technical and geological risks, the underground transition. The technical complexity of the Oko West project is also a core part of the bear case. Unlike the relatively straightforward open pit operation at TZ, Oko West involves a significant underground component. The 2025 feasibility study outlines a mine life of 12.3 years, but a significant portion of the later year production comes from underground mining of fresh rock.
Underground mining is fundamentally more expensive and carries higher execution risks than open pit mining. The transition from saprolite, soft weathered rock, to fresh rock also has metallurgical implications. The recovery rate for saprolite at Oko West is estimated at 96%, but this drops to 92.5% for fresh rock. If the fresh rock zones prove to be more refractory than expected, the projected AISC of $1,123 per ounce could easily climb toward the $1,300–$1,400 range seen at TZ, severely compressing the project's margins. The sensitivity analysis for Oko West reveals that at a gold price of $1,800 per ounce, a level that was the high watermark just a few years ago, the project's IRR drops to a marginal 18%. For a $1 billion investment in a disputed territory, an 18% IRR is arguably insufficient to compensate for the jurisdictional and technical risks. The current G Mining valuation assumes that gold will stay above $2,500 indefinitely, leaving the stock highly vulnerable to any cyclical downturn in precious metals. Financial risk, debt, streams, and the dilution cycle. The corporation's financial health, while currently rated great by some services, hides significant upcoming obligations. As of December 2025, total project commitments for Oko West and other initiatives have reached $424 million, representing 43% of the initial capital budget. However, the company only had $134.5 million in cash at year-end. This funding gap must be filled by the $350 million revolving credit facility and the free cash flow from TZ.
The problem with this structure is that the TZ cash flow is already burdened by a production-linked gold loan and streaming obligations. G Mining secured a financing package for TZ that includes a gold stream, where the company must deliver a percentage of its production at a significant discount to the spot price. This synthetic cost is not always fully captured in the headline AISC figures, but it directly reduces the cash available for the Oko West build-out. Furthermore, the corporation's largest shareholder, La Mancha, holds top-up rights that allow it to maintain its 20% ownership through private placements. While this provides a source of capital, it also creates a perpetual dilution cycle. The recent CAD $427 million placement with La Mancha at CAD 45.89 per share highlights that even with a producing mine, G Mining still needs to tap the equity markets to fund its growth. If the share price drops, the cost of this capital will increase, further diluting the existing shareholder base. The net debt figure can be misleading because it does not account for the $500 million plus in growth capex required over the next 12 months. When these commitments are factored in, G Mining is in a net liability position of nearly $400 million, necessitating a flawless operational performance at TZ just to stay solvent.
The bull case for G Mining Ventures is intrinsically linked to a global macroeconomic environment that remains exceptionally conducive to gold price appreciation. The industry is grappling with a definitive structural plateau in mined production. World exploration trends for 2026 indicate that mine site drilling has surged to a record 45% of deployed capital, as major producers prioritize life-of-mine extensions over grassroots discoveries, which have failed to keep pace with depletion rates. This scarcity of new, infrastructure-ready projects creates an asymmetric upside for G Mining, which is advancing the Oko West project, one of the largest gold projects currently under construction globally, during a period of tightening physical supply. For G Mining, which utilizes a realized gold price assumption of US $4,000 per ounce for its 2026 and 2027 guidance, the current spot price provides a massive financial buffer and significant free cash flow upside. The most critical differentiator for G Mining Ventures is its relationship with G Mining Services, GMS, a specialized mining consultancy firm founded in 2006 by Louis Gignac Sr. The G-Mine story is rooted in the success of Cambior Inc., which was built into an international gold producer through a self-perform approach that avoided the conventional reliance on third-party engineering, procurement, and construction management (EPCM) contractors. This model aligns project development with operational outcomes, ensuring that mines are built fit for purpose and cost-effectively.
The Gignac family's legacy is defined by a decade of delivering over US $2 billion in mining projects on time and on budget. GMS has been the primary architect behind some of the most successful mine builds in recent history, including Newmont's Marion mine in Suriname and London Gold's Fruta del Norte in Ecuador. By acquiring direct ownership of projects through G Mining Ventures, the management team is now capturing the full value uplift that their successful project execution offers. The corporation's ability to repeat this growth model is central to the bull case. The same engineering team that built Marion and Fruta del Norte is now focused on Oko West, a project that ranks among the world's most significant near-term supply sources. Tocantinzinho Gold Mine, the high-margin cash engine. The Tocantinzinho (TZ) mine in Pará, Brazil, reached commercial production in the second half of 2024 and completed its first full year of operations in 2025. This transition from developer to producer has provided the corporation with a steady stream of operating cash flow to fund its growth pipeline, effectively de-risking its reliance on external capital markets. In 2025, TZ produced 171,871 ounces of gold. While this was 2% below the lower end of the initial guidance range, primarily due to a slower ramp-up in the first half of the year and lower head grades, the mine demonstrated significant operational momentum in the fourth quarter. Q4 2025 saw record payable gold production of 47,346 ounces, achieved despite unplanned downtime in November caused by a ball mill motor bearing failure. The improvement in metallurgical recoveries to 91.8% in Q4 is particularly notable, as it exceeded the annual guidance of 90.0%. Management attributes this success to increased plant stability and the implementation of an expert control system that reduced variability in the flotation circuit's parameters. This technical proficiency allows the corporation to maximize recovery even as it manages variable ore types. G Mining maintains a significant structural cost advantage. Its 2025 total cash costs of $748 per ounce were approximately 30% below peer averages, while its all-in sustaining costs of $1,155 per ounce were 20% below competitors. These costs were achieved despite an US $80 per ounce impact from higher royalty costs driven by higher gold prices and the introduction of a new production tax in the state of Pará, which together added approximately US $54 per ounce in unforeseen expenses.
The mine site free cash flow generated by TZ in 2025 reached $255 million, or $1,484 per ounce produced. This cash generation is the primary engine behind G Mining's ability to self-fund the Oko West project, a rare position for a mid-tier gold company. The outlook for TZ remains robust, with a 2-year production guidance that reflects a clear path to 200,000 ounces per year. Gold production for 2026 is estimated at 160,000 to 190,000 ounces, increasing to 200,000 to 235,000 ounces in 2027. This 25% increase at the midpoint of guidance is driven by the transition into higher-grade Phase 2 ore. Costs are projected to decline materially starting in the second half of 2026 and through 2027, with 2027 AISC expected to be 20 to 21% lower than 2026 levels as grade improves. To manage the excess ore being mined, the corporation continues to utilize grade segregation and low-grade stockpiling. The Guyana consolidation, the G2 Goldfields acquisition. In April 2026, G Mining Ventures announced a definitive agreement to acquire G2 Goldfields Inc. in a transaction valued at approximately CAD $3 billion. This move is arguably the most significant re-rating catalyst in the company's history, as it consolidates two adjacent projects in Guyana, G Mining's Oko West and G2's Oko-Ghanie, into a single Tier 1 gold mining hub.
The consolidation is expected to unlock over CAD $1 billion in initially quantifiable synergies. By merging the two projects, G Mining eliminates the need for duplicate administrative support, standalone processing plants, and separate tailings facilities. The integration of Oko-Ghanie with the fully permitted Oko West allows the corporation to utilize shared infrastructure and streamline mine sequencing. Furthermore, by increasing the operational scale, fixed costs are spread over a higher throughput, with a planned 25% to 30% expansion of the Oko West mill capacity to accommodate the integrated ore bodies. This expansion is expected to involve incremental additions, such as an additional ball mill, pebble crushing capacity, and increased leach tankage. Prior to the acquisition, Oko West was expected to produce an average of 350,000 ounces of gold per year. The addition of Oko-Ghanie's 228,000-ounce potential creates a combined entity capable of producing over 500,000 ounces on an LOM average basis. This positions the Oko project as one of the largest and lowest-cost operations in the Americas. When combined with TZ, G Mining's company-wide production is expected to increase by 300% to over 700,000 ounces annually at first quartile operating costs. This growth trajectory is achieved before factoring in the development of the Gurupi project in Brazil, which provides a third pillar for growth into the next decade.
The transaction structure also offers G2 shareholders continued exposure to non-core exploration properties through the creation of G3 SpinCo. This new entity will hold G2's remaining interests in the Tiger Creek, Peters Mine, and Property B assets. Cash funding, G3 SpinCo will be funded with CAD $45 million in cash, CAD $30 million from G2, and CAD $15 million from G Mining. Contingent Value Right, CVR, G2 shareholders will receive a CVR of up to US $200 million based on resource evaluations at the acquired sites. This structure allows G Mining to focus its capital and engineering resources on the consolidated Oko hub while preserving exploration upside for the G2 shareholder base. Oko West, engineering progress and de-risking. Oko West remains the centerpiece of G Mining's growth narrative. As of early 2026, the project is fully funded, under construction, and on schedule for its first gold pour in the second half of 2027. Following the completion of the 2025 feasibility study, Oko West reported 4.64 million ounces of proven and probable reserves at an average grade of 1.89 grams per ton AU. The project boasts a robust 12.3-year mine life. The maturity of the resource is evident in the successful conversion of 2.40 million ounces of inferred resources into the indicated category during 2025, which reduced the total inferred ounces to 1.17 million ounces. The combined land package in Guyana now totals over 362 square kilometers. The consolidated mineral resource for the Oko project includes 7 million ounces of measured and indicated resources and 2.3 million ounces of inferred resources.
A significant second-order benefit of the G2 acquisition is the potential to accelerate the permitting timeline for the Oko-Ghanie portion of the hub. G Mining believes that the integrated project can leverage Oko West's existing permits, potentially utilizing a reduced-scope ESIA addendum rather than a full standalone process. This strategy minimizes development risk and ensures that expanded production remains on track for the first half of 2029, while the first gold from the core Oko West deposit remains targeted for H2 2027. Gurupi, the strategic third pillar in Brazil. The Gurupi project, located in northeastern Brazil, represents the corporation's long-term growth optionality. Established as the third pillar of G Mining's multi-asset portfolio, Gurupi provides a diversified production source that buffers the corporation against regional-specific risks. G Mining has initiated a US $21 million exploration and study program for Gurupi in 2026. The focus is on expanding the current resource base of 1.83 million ounces indicated and 0.77 million ounces inferred through both brownfield and greenfield programs. Gurupi's roadmap is designed to move the project through technical studies while simultaneously advancing the permitting process, ensuring that it is ready for construction following the completion of the Oko West build.
Financial strength and capital allocation discipline. G Mining Ventures enters 2026 with an exceptionally strong balance sheet and a high degree of financial flexibility. The corporation's ability to generate strong free cash flow from TZ while advancing two major growth projects is a cornerstone of the bull case. For the full year 2025, G Mining reported net income of $288 million, $1.27 per share. Adjusted EBITDA reached $419 million, representing a robust 72% margin. The corporation generated $308 million in cash flow from operating activities, and its mine site free cash flow reached $255 million, $1,484 per ounce produced. This liquidity profile, supported by the ongoing cash flow from TZ, ensures that G Mining can self-fund the construction of the combined Oko hub without requiring dilutive equity issuances. Capital expenditure and guidance assumptions. The 2026 capital program is the most intensive in the corporation's history as project activity at Oko West ramps up. G Mining's 2026 and 2027 guidance is built on conservative macroeconomic assumptions, providing a significant margin of safety. This includes a realized gold price of US $4,000 per ounce. With spot gold prices trading well above US $4,500 per ounce in early 2026, the corporation is poised to generate significantly higher cash flows than its base case guidance suggests, creating an AISC margin of over US $3,300 per ounce of gold sold.
Conclusion. As the industry faces structural supply constraints, G Mining's ability to bring significant, low-cost gold production online, on schedule, and on budget makes it a premier growth vehicle for investors in the precious metal sector. With its flagship assets generating massive free cash flows, a fully funded development pipeline, and a management team that has institutionalized the art of mine building, G Mining Ventures is uniquely positioned to become the next dominant intermediate gold producer in the Americas. The 2026 and 2027 catalysts across Oko West and Gurupi, combined with a projected 300% increase in company-wide production, provide a compelling bull case. The bear case for G Mining Ventures is a classic expectation story. The market has rewarded the company with a premium valuation based on its flawless execution at Tocantinzinho. However, as the asset transitions into steady-state production, the mirage of perfection is beginning to fade. The 2025 production miss, the 9% cash cost overrun, the $27 per ounce state tax hike, and the $1,444 per ounce AISC guidance for 2026 all point to a flagship asset that is increasingly average in its performance. Against this backdrop of operational normalization, the company is attempting its most ambitious and expensive growth phase yet. The $1 billion build-out of Oko West and the $3 billion consolidation of G2 Goldfields have transformed G Mining into a high-leverage bet on Guyanese geology and Venezuelan geopolitics. With a PE multiple of 34x and a PS multiple of 18.4x, there is no margin for error. Any delay in the H2 2027 first gold target at Oko West, any further tax hikes in Brazil, or any downward correction in the gold price will likely lead to a massive derating of the stock.